Hello, everyone. I'm Valerie Leonard, founder of EverThrive Financial Group. Thank you for joining us today for April's market update and outlook. And we've got a lot to cover today. It's so hard to believe that we are already at the end of April. I'm so excited that spring is here. And we know that we can expect some rain showers when it comes to markets. But the question is, what happens after it rains? Are we going to see flowers or just more market storms? So we're going to take a look at what we're seeing right now. But before we get started, we pride ourselves on proactive service here at EverThrive Financial Group. And we want to be here for you when you have questions. We meet with our clients regularly and we talk about what's going on in their lives and answer their questions and look at what's happening in the market. And if you'd like to discuss your own situation, feel free to reach out to us. Okay, so let's start by taking a minute to recap 2022 so far. Recapping is important for two reasons. First of all, it's likely that many of the same patterns and trends that we've seen so far this year will continue into the rest of the second quarter and throughout 2022. And second, first quarter and the month of April has been very mixed with lots of highs and lows. So it's important that we take a look at the bigger picture to help you understand what's really happening. So you can pause your video player here if you want to look at some of this data in more detail, but we're going to start by taking a look at first quarter market performance. All three equity indices gained in March, but still in the quarter in the red because we saw so much of a drop in January and February. And fixed income markets, so that's the bond market, also struggled against the news of rising inflation. And then when you look at the individual sectors, indices across most all sectors were also down, with the exception of strong performance in energy and a slight uptick in utilities, which tends to perform well when you're starting to see a slowing economy. So let's take a look at the S&P 500. This is a chart that goes back 2 years, and I've drawn a blue box here to kind of show you the range that we're trading in right now. This chart is as of the close of business on Friday, April 22nd, and clearly we continue to see very volatile markets, with Friday being one of the biggest down days that we've seen in several months. So what is really happening? Now, first off, as we've covered in recent videos, keep in mind that all eyes are on the Federal Reserve and their stance on future interest rate hikes. Last week, Chairman Jay Powell indicated that he favored raising interest rates faster and higher, which created question marks for investors, and that's why the market was down so much on Friday. This really isn't unexpected for many professional investors, nor is the fact that growth is starting to slow here in the United States a surprise. And when you look at the fact that we're facing higher interest rates, it may be surprising for many Americans to learn that mortgage rates moving over 5% leads to a 20% decrease in the amount of home that people can afford. And so the concern is that the economy is going to start to slow more rapidly if rates continue to move higher. Now, I want to take a look at the main risk factors that are threatening the markets and the economy right now, starting with the fact that the global conflict continues in Ukraine, and I expect to see continued volatility in the markets as we try to sort out the effects and disruptions of that war there. I also believe that the economic risks are likely contained, and that these risks don't pose a long-term threat unless conditions rapidly deteriorate in Europe. So when you think of a green light, yellow light, red light analogy, we're going to put the risk of the war in Ukraine at a yellow light for now. We're watching it. We know to have caution and to keep an eye on it. Now, next is the good news, which is medical risk. We're all tired of talking about COVID cases, and of course they continue. New spikes are much less likely to cause an economic shutdown, in my opinion, and we've learned to adapt our business practices and operate at a high level despite pandemic activity. But medical risks to the economy is likely behind us as far as I'm seeing right now. Now, let's talk about inflation. Everybody is grumbling about higher prices. We're all feeling it. And I mentioned housing affordability earlier, and we're going to be talking about inflation for the rest of this year, most likely. Now, I personally think that we're starting to see inflation peaking. We saw a lot of that kind of happen prior to the invasion of Ukraine. And then more recently, we've seen additional headwinds that have driven prices higher because of supply constraints and higher energy prices, given everything happening in Europe. But I do think we're going to start to see inflation decelerate as the year goes on. Keep in mind that decelerating inflation isn't the same thing as deflation. Those are two very different concepts. And you'll hear a lot of people talk about deflation from the 1970s. That's not what I'm talking about here. I'm talking about the rate at which inflation is moving higher is starting to slow. And that's positive. That doesn't necessarily mean prices will come down. But as interest rates continue to rise, the rate at which prices are rising should also start to slow. Also, what a lot of people are talking about is the inverted yield curve. In other words, when short-term bonds pay higher yields than long-term bonds. This concept seems a bit complex. I understand that, but what's happening now is actually really quite simple to understand. So I want you to think about it. If you were to buy an investment, you would expect to get paid a higher rate of interest the longer you hold it, right? Because you're taking more risk and lots of negative things could happen over a longer period of time than over a shorter period of time. So you would expect to get paid more for holding an investment for a longer period of time. So in a normal market, this concept holds true, but that's not necessarily what's happening now with United States Treasuries. Right now, investors are getting paid more to own short-term treasuries because they think that there's more risk in the short run. So the Fed raised short-term interest rates, and they're trying to help tame inflation. And the 2-year Treasury and the 10-year Treasury yields inverted earlier this month. And also the 5-year yields, we saw them rise above 30-year yields for the first time since 2006. So that's something we're watching closely. But the yield curve is a reliable predictor of a potential recession. And this is why you're hearing a lot of talk about it. Two things to keep in mind, though. A curve generally needs to remain inverted for weeks or even months before it can become a recessionary indicator. So no need to panic just yet. But if a recession does happen, there may still be time to adjust portfolios and investor positions accordingly if need be. So for now, we're just flagging this as a yellow light, not necessarily a red light at this point. Now, looking at market risks and charts alone, this view can seem a little bit rainy and dreary, but those charts don't always tell the whole story, and the outlook over the longer term may be brighter than you think. We've said it before, we'll say it again, it's the fundamentals that matter, not the headlines. So the economy is still fundamentally strong. Consumer spending, business spending, we've seen increases there despite all the risks. More than 1.6 million jobs were created in the first quarter, which is another positive indicator for the second quarter and beyond. So just keep in mind that there are still very good things happening. But all in all, we know investors are a bit tired of the rain showers from April and earlier this year, and we do see a continued dreary forecast for just the very immediate future, in my opinion. But don't forget, if you're looking out 3 to 6 months or even beyond that, especially for longer term investors, there's still a good chance that we will see a brighter forecast ahead, which should be hopefully good news for you. As always, we appreciate you taking the time to view our monthly market update, and we're going to see you again in May with another review and outlook. And thanks for watching.